Listen to me. If you are 61, 62, or sitting right at age 63 and a half, thinking about retiring, I need you to stop what you are doing right now and look at me. You have worked 40, maybe 45 years for your money, and you think that once you hand in your badge or turn in your keys, the heavy tax hits are over. You think, Susie, I am taking my pension, cashing out my accrued PTO, doing a big IRA distribution to pay off my mortgage, and enjoying my life. Stop! Do not do that until you understand the massive tax trap waiting to slap you in the face at age 65. Here's the question nobody asks until it is too late. Why does what you earn at age 63 and a half dictate how much money is stolen out of your pocket when you turn 65? Because of a little acronym that causes immense financial damage to retirees who are not paying attention, IRMAA, the income-related monthly adjustment amount. Here is the fear and the reality that will shock you. Medicare does not look at what you are making today when you turn 65 and sign up for Part B and Part D. Medicare goes back into your tax history and looks at your tax return from 2 years prior. That means when you are 63 and a half, sitting in your highest earning years, cashing out severance packages, taking large final bonuses, or doing giant Roth conversions to prepare for retirement, Uncle Sam marks down your modified adjusted gross income, MAGI. Then, the second you turn 65 and go to claim your Medicare, you get a letter in the mail from the Social Security Administration telling you that your Part B premium isn't the standard monthly amount. Oh no! Your premium just jumped by hundreds of dollars a month per person, doubled for married couples, because of what you earned at age 63 and a half. You worked all your life to stand in your truth and secure your financial freedom, only to be forced to pay thousands in extra Medicare surcharges because you did not plan your exit strategy. That is an absolute tragedy, and I refuse to let that happen to you. So what is the problem here? The problem is that most people think retirement planning is just about how much money you have saved in your 401k or traditional IRA. They do not realize that every dollar you pull out, every severance check, every property sale, and every IRA withdrawal at age 63 and a half increases your MAGI. An IRMAA is not a gradual slope, it is a cliff. If you go even $1 over the income threshold bracket, your Medicare premiums jump into the next tier for the entire year. That is money straight out of your retirement cash flow. Can you afford to waste thousands of dollars on Medicare surcharges just because you didn't look at the calendar? Absolutely not. Now, here is your actionable takeaway, because you know I never leave you without a plan. First, if you are retiring at age 63 or 63 and a half, do not take giant one-time taxable withdrawals to pay off debt or fund big lifestyle changes in that exact year unless you have calculated your MAGI. Spread those withdrawals out across earlier years or rely on tax-free accounts like Roth IRAs or cash reserves that do not count toward your MAGI. Second, if your income was high at 63 and a half because you were working, but at age 65 you are fully retired and your income has dropped, do not just accept the IRMAA penalty letter. You file Form SSA-44 with the Social Security Administration. This form allows you to report a life-changing event, which specifically includes work reduction or retirement. You show them that your current income is lower than it was 2 years ago, and they can adjust or completely eliminate that unfair Medicare surcharge right then and there. Knowledge is power, but actionable knowledge is financial security. Pay attention to age 63 and a half, protect your hard-earned savings, and keep your money where it belongs, in your pocket.